Well, it looks like we're live. Welcome everybody to our CMAP or Mortgage Bootcamp live stream, call it what you like, our weekly update on everything to do with mortgages and some new information to help you along the way. So big week this week for the mortgage sector. We've got Sunak's budget on Wednesday. Well leaked, I think, like all these things. Oh, Laura Koomsberg seems to get all the leaks, doesn't she, about what's going on. So let's wait until we hear the detail. Let's not predict too much. Although, if you look at some of my live streams back in January, I predicted the mortgage guarantee scheme. I said he'd come up with that, didn't I? And I generally tend to be right. So there you are. Enough of all that. Let's talk about a couple of other topics for you to keep you going. Got a new shirt on today. Do you like it? Maybe a bit too snazzy for video. I don't know where it will get a bit shaky along the way, but there you go. We're not here for fashion advice, are we? Still locked down, of course, and the mortgage market and the financial services sector is still doing okay, even with the stamp duty issue coming to an end, although that may well be extended, but we don't know about that, do we? A couple of topics for you this morning or this afternoon. One's on equity release and the other one is on a bit of an insight into the mortgage market and where you might want to be taking it over the next sort of 6 to 12 months for you. Let's crack on with our first topic, shall we? Yeah, hi, welcome. Let's take a look at the subject of equity release and suitability. So we're a bit of a dry topic, really, I suppose, at the end of the day. But we're talking here about equity release. So those of you who are getting yourself in that marketplace, this one is for you. And I want to talk about suitability here. Now, the pure fact is that, here we go, suitability letters. The pure fact is that with equity release, the vast majority of mortgages, therefore, you need some kind of suitability letter. Actually, strictly speaking, you don't, but you do. Now, the suitability letter, as you know, is the item which you send to the client once advice has been given, confirming why you've recommended, etc., etc. It's designed really as a sales aid for the client to understand why you've done what you've done. But because that gets far too compliancy and far too regulatory, it ends up being a document just to prove yourself. So if you're sued later, you can prove what you said, which is wrong in a way because most clients therefore end up don't reading it. It's full of templates and caveats and clauses given to you by your compliance department. Well, I'm not there to knock that, but you do need to have certain content in your equity release suitability. I want to talk about these areas in which you need to talk about with the client. This, of course, is down to the fact finding. It's also in suitability as well. Now, the first thing you need to decide upon, though, is the loan itself. When you're advancing the money, because this is an equity release loan, what are you giving it as a lump sum? Are you doing it as drawdown, or are you doing it as income? You need to justify why. If the client, for example, wants drawdown, you need to give reasons why you're giving drawdown. Drawdown is different to a lump sum. In fact, you draw more money down whenever you need it. You kind of pre-agree money you want and you draw it down as and when you need it. It stops you storing it away in order to produce income or interest, which is obviously not a good thing. Income is a very different area of need, but you've got to justify the kind of loan that you're giving. And another one comes in is affordability. You've got to justify why you're looking at the person's affordability aspects. Now, affordability itself comes down to fees and costs. Are they aware of all the fees and costs involved in the equity release arrangement? That's affordability, isn't it? Is it a home reversion plan that you're talking about? Is there ground rent to pay, etc.? So you've got to look at the affordability factors based upon that. But the biggest one, though, is the type of mortgage. If it requires interest payments, then you need to do affordability. So you need to show in suitability that the client's affordability is sufficient to afford the interest-only mortgage payments that have to be made on the retirement interest-only product. So that's affordability. And the big one now for you is alternatives. Here we go, alternatives. Now, alternatives is key for equity release. This is where you have looked at all the other alternative means of financing whatever it is they need the money for. So say, for example, it's to provide a deposit for Jim to buy his first property as the grandchild. And maybe it's sort of £25,000. So you've got to explore other avenues. So it could be looking into savings. It could be borrowing elsewhere. It could be letting Jim take out the mortgage in his entire name using the government's guarantee. Different options available to produce the same amount of money needs to be talked about and confirmed in the suitability as well. Everything needs to be simple. They call it simplicity. So make sure that everything is simple to understand. The words themselves in the suitability report are easy to understand and construed by the person who's reading them as well. The house itself, or the home, you need to confirm why the home is being used as security for the loan, and the disadvantages and advantages that this causes, of course. Any roll-up interest needs to be clearly stated in suitability itself. The Rule 72 needs to be advanced a bit more at this stage. You need to have a proper sort of schedule showing how quickly the interest will roll up on the mortgage, because you'll know the interest rate at this stage. Reconfirming the no negative equity guarantee would be a key one at this stage as well. Any lease conditions if it's a home reversionary plan as well. And the home reversion plan, of course, where you actually lose the property, you're now a tenant, that needs to be clearly laid down. The details around the home as well. Longevity of the loan is a new one, really. I put that in there for you. Longevity. This is an area of the loan which the FCA are watching like a hawk at the moment, because equity release mortgages are lifetime mortgages, hence they call them lifetime mortgages. They go on forever. They're not like a 2-year or 4-year fix where you can rebroke the mortgage. That don't work that way. This is like a long-term thing. You fix, keep it going for the lifetime. So you need to make sure that you've assessed the ability of the client to keep the loan for the long period. So you've done a bit of work on their lifeline, for example. You've projected their world 5, 10, 15 years forward, if you can. You found out a bit of information about why they're wanting to have this for the lifetime, what their ambitions are about the home or the area they live in. The loan itself needs to have longevity, it needs to have legs, rather than just a short 2-3 year fixed rate mortgage. It's a different world, you see, and you have to justify that in your suitability report as well. You'll need to talk about inheritance, of course. Inheritance is an issue because the inheritance is something that's going to be affected by the loan, because you're reducing equity, however you look at it, home reversion plan or lifetime mortgage, you're reducing the equity in the property, and that will may be inherited by some kind of beneficiaries. So you need to talk about that. The impact on inheritance tax might be something to mention as well, but it needs to be quite crystal clear the fact that your inheritance you're able to pass on to your next of kin, your children, is going to be a lot lower, and why that is happening and the benefits either way for you as well. So that's key, isn't it? One that is very unique to equity release is what they call the better off test. Now, the better off test is a regulatory requirement, and rightfully so as well. This is to prove that the advice you've given, the mortgage that you're arranging, whatever it is, the home reversion plan, is the client is better off with that arrangement than without. That might sound a bit daft. Of course they're better off, but the fact is you might have knocked out any welfare benefits. They might not therefore be able to apply for certain welfare benefits, pensions credit, for example, because the advice you gave means they can't apply for that anymore. So they're worse off. The taxation situation might be adversely affected by the advice you've given. You've got to prove that they are better off financially by the arrangement you've given them. So you've got to be very careful with that. So you need to have some kind of printout showing the effect of state benefits on the advice, whether they're going to lose them or gain them, and the impact on taxation as well. That's pretty key stuff, that one as well. Legal capacity is another one. The client's got to have legal capacity to be able to go ahead with this arrangement. So that needs to be confirmed in the suitability as well. A couple of things here. Powers of attorney. If they haven't got one, you need to get one arranged, and that needs to be part of the advice that you give. So power of attorney is really important. Have they got the legal capacity to borrow? Are they not vulnerable in any way? Do they understand what they're doing, etc.? Because the lawyer will check for legal capacity anyway, so you want to make sure that you've done the job as a mortgage equity release advisor. Maybe some people living in the home over the age of 18 needs to be looked at. They lose their rights, of course, to possession of the property, so that needs to come into the discussion. So there's lots and lots of things going on there as well. I suppose you could always look at the property itself, the type of property. Let's just squeeze that one in there for you. I don't know if that's come up on the video. The area that you're in, the type of property would form part of the suitability as well, giving you details about the property that's been taken into account. So quite a lot of aspects of a suitability letter. Make sure that you do it so the client understands it. It's so easy, isn't it, to have paragraphs and legal templates and disclaimers and things like that. And you end up with a 25-page document, and most people don't read 25-page documents. Okay, what you say, they don't do it. They'll see it and they'll throw it away because they trusted you anyway, so they're not going to not proceed with the case. They just want to know where to sign, don't they? But the suitability letter is certainly an important part of the advice that you give on equity release. Hope that's been useful. Bye. There you go. Did you like that one, did you? Big market equity release, a very big market, really coming into its own now as this COVID thing gets over with. People are more aware now of the value of property and staying in their home, not moving for any reason. People like to stay in their home with their family. It's been a source of security for many people in the last sort of 8 to 12 months, particularly those vulnerable, or the elderly as well, who are more susceptible than COVID than anybody else, although they've all been jabbed now. I haven't had my jab yet. You had your jab. I don't know when you're due for your jab. Apparently we're going to get a text, aren't we? I was thinking of popping down there, see if I can get one at sort of 5 o'clock, a bit like when you used to go to the supermarket at 5 o'clock when you were a student and get all the food that's going to go off for the next day, see if they've got any spare toasters. But I think actually I'll just wait. I live in my basement anyway, down here, so I don't go anywhere, so I'd rather give it to people that need it more. In fact, they should give it to the coppers, really, I think, rather than me. They much prefer, much deserve it, I think, at the end of the day. Let's move on to another topic for you. Finish off our live stream. Hope you're well, by the way. Hope you're keeping up and surviving. If you're in the mortgage market or you want to get into the mortgage market, I've got some news for you that might actually make you think differently. Hi, let's talk about what I call the sonic boom in mortgages, is what I'm calling this one for you, the sonic boom. So let's put this title over here so you can see that one. The sonic boom in mortgages. You'll like this one. This is very logical, and you'll like this a lot. I was reading a story the other day about the east side of the country, Essex, Lincolnshire, Norfolk, Suffolk, lovely part of the world. But a lot of the Air Force bases are based over there because back in the day, of course, they were the closest to the continent, and the Russians and whatever, the Soviets as they used to be, were the main enemy. And of course, they're still based there. Now, the other day, I heard a story of a private jet that was flying over from the continent. And it lost its communication signals with air traffic control. Therefore, the alert went out, Homeland Security, alert, alert, alert. So, of course, they took off some jets from, I think, Spalding area, from some Air Force base. Of course, they had to intercept this private jet as pretty darn quick as they could. So they went into, like, speed of sound across the land, which is very unusual. Apparently not allowed to do that. Anyway, hurtling across Essex, and they had this sonic boom, this great big crash in the air, and the noise was like an explosion, and local people were up in arms about it. Glass shattered and everything because these jets went on to the speed of sound. Now, that sonic boom, which was rather frightening, is exactly what's going to happen to our economy this year in 2021, and you need to look at the logic behind it. Businesses have got war chests. These are businesses that have done all right in the COVID situation, of course. As many haven't. Leisure, hospitality, I know that, have tanked, and they're looking at ways of surviving. But a lot of businesses have done okay, and they've actually produced some extra money, not spent it. They've got war chests, as I like to call them, as do a lot of consumers, who again haven't struggled with the COVID. A lot of people have, and I get that, but some people haven't, working from home, got no expenditure, no season tickets. So a lot of consumers have got a lot of cash as well. And they've been cooped up in their homes for months and months and months, getting cabin fever. Who hasn't? Let's be facing it. So they are ready to start spending. They're ready to start exploring, traveling, meeting people again. The economy in many sectors is going to go bang, as I call it, the sonic boom, particularly in entertainment, leisure, travel, and all those good things. So that's a great thing. Now, the housing market itself, the mortgage market, housing market, is also going to go through some incredible movement as well. It's going to grow for a number of reasons. People, first of all, want to upscale their homes. They've lived in their homes continuously, 24 hours a day, 7 days a week for the last year. So many people want a bigger garden. They might want a spare bedroom to turn into a study. They might want a downstairs study. They might just want to move out of town because they don't need to live near the railway station anymore because their firm isn't bringing them back to the office. I mean, we've got 68 million people in this country, 40 odd million working population. There's quite a big proportion of those people working from home. Therefore, they will want to move house. Now, the government are helping. They're bringing in the high loan-to-value guarantee backing facility, which I predicted a couple of months ago, by the way. They're bringing that in the budget this week. Let's wait to see what happens, the detail there. So they're helping first-time buyers get their 95% mortgages again on second-hand properties. That's all the market needs. Once those guys come in and start buying the smaller places, then the whole marketplace just trickles upwards, whether they stop stamp duty or not. You'll find a massive number of first-time buyers who didn't really get involved in the last few months with the stamp duty. They were pushed out of the way by the landlords that had the cash on the first-time properties, but they're going for it. Oh, a lot of landlords, by the way, are offloading some of their properties now because of the predicted hike in capital gains tax for second-time purchasers and landlords. So they're putting supply in as well. So it's very, very rosy, and it's bountiful, if you like, the supply side effect in the mortgage sector. But you see, the problem you've got, though, and this is the big problem, you've got all this demand from consumers, businesses, and the economy in general. You've got a lot more people buying properties, as we talked about. So demand is great, but the problem we've got is supply side. Because in any marketplace, particularly in the economy, you have supply of goods and services, okay, goods and services, which is all about businesses, isn't it? That's actually GDP and everything like that comes into that. There's also imports as well. You can't think about just this homegrown stuff. That's supply of goods and services goes to the economy. And then, of course, you've got the demand. And I've talked to you about demand rocketing. This boom, as I call it, demand boom, the sonic boom, which is logical. But what you've got here is a supply side problem. You've got a supply side problem because you've got a situation where, well, I call it supply shock. You've got the ability to supply goods and services has been restricted. Okay, we've got Brexit, which hasn't helped. That's caused a lot of the importing to be held up, particularly in certain parts of Northern Ireland, Republic of Ireland, etc. You've got issues around the continental Europe importing, exporting. They're going through some problems. Apparently, in a couple of months' time, they're going to start having a bit more paperwork. So that's prevented supply. And we import a whole lot more, of course, than we export. We know that as well. You've got a bit of a recession, which has caused companies to contract. The COVID thing last year, a lot of companies buttoned down the hatches and shaved off a few employees and cut costs where they could to try and survive. It's very difficult then to rejuvenate that again as well. Many have offloaded staff too quickly. Many are slow at unfurloughing staff. It takes time bringing somebody back who's been off for 6 months. You'll retrain, remotivate, got to get premises back together again as well. There's warehouse shortages of goods and services as well. I mean, the list goes on. There will be a supply shock. In other words, that's going to be restricted. That's going to boom. That's going to be restricted. So what does that cause? Quite simply, that causes supply to fall, demand to increase. And what happens to prices? Let's do that in red. Prices, of course, go up. We know that, don't we? You could look at a couple of examples. Look at PPE back in April, May last year. Protective equipment, which was a worldwide shortage. Prices went up, didn't they? Because governments would pay any amount of money to pay for PPE at one point, and ridiculous prices were being paid because supply was restricted, demand was high, prices go up, and that's what happens. Of course, what does that cause? That causes inflation. Now, inflation itself, we've had years of quantitative easing. The government are printing money to pay for the debt anyway, and that in itself inflates money supply. So there's plenty of money around, so they're just used to buy bonds as well. Government borrowing, of course, they're still borrowing to pay. The government, of course, contribute to demand as well, because they're going to be spending, aren't they, as well? So inflation is going to start to go up. And it will. There's talk about it never going up ever again by some of the modern monetarist theorist people, but inflation will start to go up because prices will go up. Because they will. Because this is logical, isn't it? So anyway, when prices start going up, in other words, when inflation starts rising, generally speaking, we get a bit concerned and worried. Will they get worried this time? I don't think so, and I'll tell you why. There's a couple of things, first of all. Now, inflation is bad for people who are on savings or fixed pensions or some kind of fixed income. So if you're retired and your income from pensions is not index linked to any great degree, or if you're just living off your savings, inflation is not good. And generally speaking, it's not great long term for any economy as well. But it's good for two types of people. It's good for people that own assets and have debts. That's the key. Let's put that in black for you. So prices going up causes inflation. And we measure inflation with the CPI. And at the moment it's 0.5% something, but it'll start going up. But it's good for people that have assets and they have debt. There you go. Assets rise because everything starts to go up in price. All assets go up in price too. Like gold, shares, property, all those sort of things. And it's great for debt because the value of your debt goes down in comparison because inflation erodes the value of money. Therefore, it will make your debt less than it really is. And guess who else loves this? You got it. The government. The government have a massive debt pile now. They've spent 300 billion or something on COVID. We've got something like £2 trillion as a government total debt. It's enormous. Yeah, they'll sort it all out shortly by stop borrowing as they go along once COVID gets under control. But of course, they've still got this debt pile. Now, of course, inflation rising reduces the value of the government's debt because GDP rises eventually with inflation, assets, etc. So government debt pile will get inflationized, and they'll love that. That's what we did after the Second World War. We just encouraged inflation, took off in the 70s, got out of control. We got rid of the national debt, which, by the way, proportionally was far bigger than it is now. We just won a war. We had to buy planes, aeroplanes, all sorts of bombs and stuff like that. So expect the government not to prevent this inflation. They quite like the idea of a little bit of inflation. They'll come up with some sort of economic reason why we should have inflation, because that's the only way they can get rid of the debt. Or they can just print some more money and pay it off that way, which is obviously what they've been doing. So as far as the mortgage market is concerned, this is the best thing at the end. Assets, debt, that's what we do, isn't it? We help people to buy houses and we give them mortgages. So it's a good thing as far as we're concerned. So demand is going to be good for us. Make sure, though, that you look at the fixed rates that you give people, because interest rates, of course, will start to go up again as well. As inflation rises, interest rates rise because we still operate a monetarist type economy, doesn't it? Rishi Sunak will soon put interest rates up, or the Bank of England will anyway, as inflation starts to rise. So make sure you do some good fixes for your clients. 3 or 5 year fixes keeps the monthly payments bearable. But of course, mortgage demand will be good because it will. So the moral of the story is make hay whilst the sun shines. It's our sonic boom. Let's make the most of this moving forward. Hope that's been useful. Bye. Did you like that, did you? Hope so. Yeah, interesting times. Yeah, we're bringing in loads of new mortgage advisors into the marketplace right now. We've got lots of people coming on our boot camps who want to be mortgage advisors. Remember, we help you become a damn good mortgage advisor, not just to pass the exams. We do all that for you, of course we do. But we hold your hand all the way through the process, because my motto, my principle, my belief is I want to bring as many new people into the mortgage market as I possibly can over the next few years, because we need more people advising on mortgages. We do, because there's not enough of you. And we need people to be able to cope with all this demand as well. Got 2 more spaces left on bootcamp if anybody wants them. We've extended the official start date to the 8th of March. So 2 more spaces left on bootcamp. If you want to come over and email and get some details on that, we'll get you in there. We started officially this morning, but we're starting officially on the 8th, because we've got 2 more spaces just to fill in for you. Had a load of crowd people on live streams this morning, so it's all going really well. EmmaPaulArcher.com, archtraining.com, wherever you want to go. It's up there, is it? Over there, is it? That's the mortgage advisor thing. If you need to contact me, other than that, we've gone on over 20 minutes, so I'm going to wrap up now. We'll see you all next week. Oh, by the way, Wednesday, budget. Let's make sure it looks good. I'll probably give you a report on the budget next Monday. But by then, you would have consumed all the newspapers and information. I'll give you my take on the topic. How it affects mortgage advisors is the key to what we talk about here. Have a great week, and I'll see you next week.